Billy, welcome back to the show.
Hi.
It's always good when we get to chat, Billy, because we get to talk both bottom up, we get to talk technology, global investing, all these types of things, which is what we're going to talk about today. But there are three questions that I want to talk to you about that are just more like just things that I'm really interested in, and I think you'll lend a really interesting perspective to this. First of all, it's an easy one, and you're saying stuff there how you get asked questions like this a lot, which is a bit of fun. What would be the most interesting company to you now? You invest across the world. You know, you've got a depth of experience here in Asia, but also in the US. What would be that company that you find really interesting?
Yeah, I think it's more to do with timing. I think that will be what's the most interesting company to me right now. Yep. And I think it would definitely be a Chinese company, which resonates with me because I've been covering this name for a long time. It's called Tencent.
Oh, yeah.
So Tencent is one of the largest, online games platform in China, one of the largest online social media platforms in China, one of the largest online payments in China. They're also doing artificial intelligence, developing all the large language modeling. But they also have a huge overseas presence. So they actually have a huge stake in Ubisoft, which is also a major gaming company globally.
Oh, yeah, of course.
In terms of their revenue, at least about 20% of the revenue are actually from global. That includes Europe, Asia, Japan, and Korea as well. What I find interesting is that this company, which is all this, still growing, is trading at about 17 times forward PE, which is below the average, 5 years average of about 21 times PE. And I think it's incredible that we're seeing, despite all this innovation and technology and all this headlines on DeepSeek, headlines on artificial intelligence, we're still seeing a company that is trading at this kind of valuation.
Yeah, that's really interesting. Tencent is a business that even people that don't invest into China would probably know or know of. And I forgot about the Ubisoft thing.
Yeah.
That's so, obviously for people that don't play video games, that's like a massive deal. The gaming engine and all that sort of stuff around that, which is really cool. Another question that I have for you is more around technology and the evolution of it through time, is when we first saw the emergence of OpenAI, the big knee-jerk reaction from people at the time was that Google search and the way you find information was going to fundamentally change. And this is still, it's an evolving thought, but still people have this with quite conviction is, well, why would you Google something? Why would you search for something when you can just use an AI? It doesn't have to be OpenAI to just deal with it, like to find the answer for you. How do you think about maybe the impact over the next 5 years on a business like Google with the emergence of these large language models?
Yeah, that's a good question, and I think it's an ongoing question, not just with Google, but with a lot of innovations as well. And it's got to do with when you deal with internet or online, it's actually not just a one-way process. It's actually a two-way process. You need traffic, and then you also need, it's more of the supply and demand as well. So let's use search for instance. What Google does is essentially it connects the users who are looking for items, looking for services, but it also connects them with the people who are providing the service. So it's actually a two-part equation. So when you talk about DeepSeek, yes, they are able to search, but whether or not they're able to search the correct ones or they actually have access to the correct services, items, or information, that is also one thing that they don't do well without a platform such as Google. And on the other hand, the traffic that goes into DeepSeek, is or ChatGPT, where do they come from, But, with Google, they actually control both sides. They have ability to actually efficiently control both sides. So I guess my view is that, yes, DeepSeek is great, but it's more of an enhancer or an enabling platform where, companies such as Amazon or Google, they can use the current services and apply, the new technology. And that's how the development comes in.
So you don't see the emergence of these LLMs, whether it's DeepSeek, OpenAI, or any of those. You see them as more of an enabler for big tech rather than anything.
Correct. I think it's the converse. I think it's because of these technologies we find out that there is a much more efficient, much more cheaper way to actually adopt new services, adopt more new powerful services. And I think that's been, very evident with the past as well. I mean, even with Google search, we've obviously made it much easier in terms of artificial intelligence, simply searching and adapting to our needs. Even, I guess home services such as, your Google Box or your Amazon Box, that's actually much more efficient because because they're learning an ability to, I guess, adapt to our thinking as well.
Yeah, because it's just they have the deepest source of data, I guess,
Exactly,
and the ability to do all that. So I know you mentioned Tencent before, and you spend a lot of time researching companies in China in particular. Do you see any implications for DeepSeek separately, like the technology and its implications to maybe to the West, but also just to everything else that's going on?
Yep.
When that news emerged, and how popular it's become so quickly, how do you think of the implications of that?
Yeah, I think that's also another big topic that people are discussing, especially when the first DeepSeek headline came out. Major stocks fell substantially. We saw very big moves. So I think in terms of net effect, I would first start off with it's going to be net positive for the artificial intelligence development. How I see the emergence of DeepSeek is that this is more a recalibration rather than a evolution or revolutionary moment. And the reason I said that is, I think we discussed this before in a more technical artificial intelligence discussion, was machine learning is actually two parts. One is training, where we teach the machine what an apple is. And the second part is inference, where we put them to test. We throw them with different pictures of apples and see whether or not they can identify it. Now, a lot of, investments have been put into training previously because, in order to make it more powerful, they put more money in terms of making them much smarter and, ability to understand more. Now, with the emergence of DeepSeek, we now know that training could be much cheaper. For various reasons, the technique that's involved. And so in terms of the net effect, people are going to go, hey, maybe we don't need to invest that much in training, but the net investment will just be shifting towards inference. Instead of spending time and money and effort in terms of training machine, we'll now put it more into the inference section. And I think that's what's happening right now. In terms of, Google, Amazon, they're spending more on inference, even Meta is. And going back to your question about how China is impacting this, I think it's the same shift as well. We're seeing the same in terms of investment shift. Companies such as Tencent, Alibaba, moving along and investing in this area. I don't think this is a more geographic tension or geographic competition between the companies. I think more it's a global development, and I think it's working fine.
Yeah, that's really interesting. That inference component especially is really interesting to me. I'd like to talk a little bit about this well-established bias that most people have throughout the world, which is home country bias. And this is because we want to talk about global investing and the benefits of it. But a lot of people historically, Billy, as you know, have a tendency to invest closer to home. And that's not necessarily an Australian thing, although Australians do have a very significant proportion of their assets here in Australia. A lot of superannuations invested in Australia. You've got your property. You've got your own assets outside of those two vehicles as well, which is obviously invested here in Australia. Are you able to, or do you know roughly what the context would be around allocations between global investments and Australian investments?
Yeah, that's a tough one. There's the numbers that flow around. One thing that I was looking at was just on the superannuation front. The size of the superannuation is obviously huge in Australia, but in terms of where the asset is allocated in superannuation, it's actually half in Australia and half in overseas, so which is a really big sort of mix. In terms of actual ETFs, we do have a more swing towards, global equities, and the function of that is because there's a lot of non-Australian derivative products as well that's involved in ETFs. So I think that's where the swing is. But I think, what's interesting, what we've seen is that in terms of year to date, at least this year, we've seen a lot of flows in the ETF going into key Australian indices. And, in terms of Australian focused ETFs, they're ranked first or third in terms of ETF flows year to date, accounting for about 20 to 30% of the total flows, about 2.6 billion. So I think, historically, yes, it's been a blended mix, but I think we are seeing, maybe due to various political reasons, we are seeing more and more, shift into Australian equities by Australian investors.
Interesting. Yeah, because I remember when I used to look at the ASX investor data, this is a survey that the ASX used to put out every 3 or 4 years or something from memory, maybe less, maybe it's 2 years, more frequent. And they used to show really interesting data around, I think it was going back about 5 to 10 years, only about 10% of Australians owned shares overseas.
Yep.
But that's because I feel like, directly I'm talking here, that would have been pretty hard. But thanks to the proliferation of ETFs, like one of the ETFs I want to talk to you about is FANG, which is hugely popular, right? And that provides direct exposure for Australian investors through an ETF wrapper directly into US mega cap tech. And I feel like that has democratized a lot of global investing.
Yeah, I think you're right, Owen. I think you're right. I think there's a few things. I think, there's definitely that ease of access in terms of overseas equities, whether it be through ETFs or even just through platforms, various platforms that now you can simply set up your own account and invest. But I think more importantly, it's also not a cultural shift, but also a development in terms of global economy. So if you think about, I guess 50 years ago, there was no tech or no innovation. It was very old economy, banking, it was financials, it was energy, materials, building blocks, infrastructure. And these were very, I guess, old traditional economies, which I would say was very readily available if you're investing in any home country. You would have that infrastructure and building block in the listed entity. But what really happened, I guess, in the last 20 or so years was more innovation. Innovation began to pick up. Innovation began to drive not just, I guess, equities, but also drive economic growth, drive overall investments in corporate as well. And I think that's when people realized that you can't just, expose yourself to domestic, to be exposed to innovation or other sectors. There is that need to go outside of your country to be aligned, or at least to take advantage of these developments, especially in innovation.
One question I wanted to ask you, which was just more a bit of a fun one, is because you've had this, we've spoken about in the past, this kind of rich experience with research in individual companies. You still do a lot of that yourself, as well as the ETFs, obviously, here at Global X as well. How you personally invest, like how do you think about where you allocate money and what types of structures do you tend to use? Like, how do you just think about that?
Yeah, I think first thing is what's also related to what you were mentioning is I tend to invest outside of where I live. Yeah. And it's what I call a personal hedge or a life hedge. So, whether or not you're working in a specific country, let's take myself, for instance, I'm working in Australia, whether or not you have a business in Australia, your life or your career is aligned with Australian economy. If something fails, if something happens, you will be I guess impacted as well. So what that means is that if you were also investing in Australian equities, very likely you would also go down. I mean, it's just a matter of beta and correlation. So what I usually tend to do, when I'm living in a certain country, I would invest outside of it. So just to give you a perspective, when I was working in Hong Kong for over a decade, I only invested in Hong Kong stocks for about 1 or 2 times. That is the truth. Most of my investments were outside of Hong Kong in US. And that was because, look, if I was investing in Hong Kong stocks, anything happens, very much correlated to my work as well. So that was one. And so having said that, even in Australia, what was good is because now I invest outside of Australia, maybe in Hong Kong or global equity. So that's something which I think is interesting perspective for myself, try to invest. Yeah. So obviously, you mentioned the home bias because you're familiar with it. You wake up and you see various companies which you're familiar with. That's always a point. But number 2 is I think it's always important to play your edge. I see a lot of investors trying to be too overcomplicate things. They try to do things. It's always great to learn, but at the same time, play to your edge. If there's something that you understand, if there's something that you're familiar with, whether it be your culture, your family, your job, play to the edge. And for me, I've always been interested in research in innovation, technology. So I've been investing in technology quite a while, whether it be stocks, and it has been successful in the way because I have been doing this for ongoing and I know it well. And some people might say technology is very complicated and very hard to grasp, but I would also say I would not know anything about mining companies. Yeah. Whereas some people would say that's very, straightforward. So I would always say, think about where you're living and how you hedge your own personal risk. Like you said, people you might invest in, your properties here, why not try to invest outside of it? And also play to your edge.
Yeah. It's actually quite interesting because a lot of people don't think about it that way, really. A lot of people think about, so I see it as it kind of bugs me a little bit, but some people that have say, I use the example of a tradie that might either run their own business or work for a commercial side or something like that. That then, so their income and their dependent, they're on that bandwagon. They also want to invest in a property because that's what they know, and it's familiarity, which is fine. So they've got their home, they've got an investment property, they work on a construction project, and their super is probably CBUS, which is the big industry fund for the construction industry. So you basically have all of the chips on the table, and not to mention it's all in Australia, all of the chips on the table for one industry and one profession. And you can understand why people get to that, because it's familiar.
Yes.
They understand it, and therefore they're more comfortable to have a significant allocation. But at the same time, it's tricky because all of the diversification rules basically go out the window with that.
Yeah, that's interesting because, so many years of, I guess, educating about, putting your eggs in one basket, we're still aligned, with trying to go where it's comfortable. And I think you're right. People still do that.
Yeah. So one of the things we wanted to talk about today is Global X has just launched the Global X Russell 2000 ETF. And for people that don't know the Russell 2000 index, I'll get you to break that down in a minute. But this is one of the most popular indices if you're in the US and you're looking at this universe. I'll explain this in a little bit, but it is one of the most popular indices for people that are kind of a bit more discerning, is what I would say. So this ETF kind of brings that all together. And as someone myself, Billy, who's looking at different valuations, the US market, different markets around the world, I think that there's going to be some change. I'm curious to hear your thoughts on this around, like, say, AI, which you mentioned as like an enabler for Google and all of that.
Yes.
I also think it's a tremendous enabler for that mid-tier of companies.
Yes.
Like not the tiny companies, although they could use that, but I'm thinking about companies in the $10 billion range, the 50 billion, the ones that aren't at the top of the leaderboard, but they could use technology to unlock a lot of, growth in their business and a lot of productivity. So let's start with the basics. Can you tell us what this ETF is, what it gives us exposure to, that type of thing?
Yeah, so the Global X Russell 2000 ETF, so the ticker code is RSSL, very easy to remember. So it tracks the Russell 2000 index, which is essentially the 2,000 smallest companies within the Russell 3000. So the Russell 3000 index is the 3,000 companies in US. We have the Russell 1000, which is the highest 3,000 or the largest 1,000. And then we have Russell 2000, which is the smallest. So essentially, it's the combination that creates that Russell 3000. So they are sort of small to mid caps, or what we call them. But the key is people keep thinking that these are very small, unhealthy companies, which is a huge misconception. So on average, the Russell 2000 companies, weighted average market cap is actually $3.9 billion US dollars. So they're not small companies. In terms of debt level, they're actually on par with the S&P 500 names. So it's not actually very weak companies. But what we do have to note is that in terms of profitability, about 60% to about 65% of the companies are profitable. So that's probably the key difference. But I think what's interesting is probably more on like you mentioned, there's this sort of interesting aspect of the mid caps. But what's also interesting is that taking a step back is, we do have a very strong conviction on the US, what we call the US exceptionalism, and this is in a way where we think that investors need to be exposed to US, mainly because US is still registering and will grow faster than the developed countries in the next few years. So I think there's a very strong point to be invested in the US. But the key is, where to invest. And I think that goes to your point about, who are the major beneficiaries of the next 10 years. And one thing we look at is what we call is the market broadening. And the key aspect of that is we believe that, in the past few years, the S&P or even the US market has been driven by large caps. And we do believe that there will be a trend of market broadening in the future as well.
Yeah, it's really interesting. I know it was only launched recently, this ETF, but I think this is what people are looking to use to complement existing core portfolios. And the thing that was interesting to me is it's only got 18 basis points or 0.18% management fee, which is very low for this type of fund. I know it's only early days for the fund, but what is the kind of view here in terms of how you see this being used? I'd imagine you don't see it as necessarily a replacement to US equities, but as some type of blending?
Yeah, correct. So this is exactly why we're so convicted on the whole US market. We believe US is a place to be invested in, but we also think that we should be spread out in terms of where we are. So to use your example, for example, as an instance, is that we have the large caps, which for example we have a product called FANG, which collects the concentrated large caps. But at the same time, we also have to look at the tail or where the smaller companies are benefiting. And I think the key is because if you look at Russell 2000, the key difference between them and also I guess the larger, broader indices such as S&P 500 is apart from being smaller, it's also a different sectorial approach as well. So the S&P is very tilted towards technology and consumer staples, whereas the Russell is very tilted towards industrials, financials, and healthcare. So like you said, it's not about replacing your broader indexes. It's about saying, hey, maybe you've got too much focus on IT, you've got too much focus on consumer staples. Adding this or blending this Russell 2000 will allow you to have exposure to industrials, financials, and also energy as well, which is more better diversification, especially in times of geopolitical tensions and even, I guess, the new US administration.
Yeah. It's I can see that here. I've got the numbers up in front of me. There's still a meaningful exposure to healthcare, to IT, industrials, these types of businesses and industries. And I think, did you say 3.5 billion before?
3.9 billion average weighted market cap.
Yeah, well, so that's significant, right? That would be,
so not a small companies, correct?
Yeah, that would be huge in Australian terms. That would be a big company by Australian standards. And you did a really good write up not too long ago about the kind of opportunity set and what's included. So this would mean, if I'm thinking about the different structures that are available from Global X and just how they kind of line up, there's the U100 ETF, FANG, which is a household favorite here on the show, Russell, RSSL, and PAVE, which is about thematics. I would like you to talk to us about where you see, how do you see these being made up across a portfolio? So if we've got U100, is that core, is that satellite, in the way that you would conventionally think about it, FANG, et cetera? How do you go through them?
So how I look at it is, like you said, we as Global X, we have this suite which has that sort of US focus, and with FANG you have that concentrated name. So FANG is essentially the Mag 7 plus 3 high growth names. So this has been doing well, obviously because of the concentrated growth in the US. Now so this has been what we've been recommending as a core part of the portfolio, because we still believe that innovation will be the key driver of US or even global going forward. So this is an integral part. We also suggest, or we also have a blend of U100, which is the top innovative stocks in the US. So with U100, the key differences between this and also many NASDAQ-based company indices is because we don't believe that NASDAQ now represents technology stocks. Right. So, for instance, if we look at U100, which includes all the NYSE listed stocks and the NASDAQ stocks, and we put in the technology filter, what we found was that there was actually a lot of missing companies that you would not get with NASDAQ. For example, you will not get ServiceNow, you will not get Salesforce, which are both very successful companies, but not included in NASDAQ. So that's why we expanded the universe, which was interesting because that actually improved the performance and also allowed us to see that there was a lot of non-NASDAQ performing tech names. So that sort of created a really nice mid section in terms of the US growth. And then to your point, we have Russell 2000, which has the more smaller names, industrial, financial, and healthcare blend. So those set up our core US portfolio. Now, going back to your satellite placement. So the satellite sleeve, we have been talking about PAVE, and PAVE is the Global X US Infrastructure Development ETF. So what's interesting there is because a lot of people look at US as a place to be with the US exceptionalism, but they're also trying to find an area where we won't be impacted by global supply chain disruption. And I think this is key because a lot of investors are saying, we don't know what geopolitical tensions will cause, we don't know what tariffs will cause, and they're really concerned about this area. And what PAVE, or the Global X Infrastructure Development ETF, does is the top 100 stocks in US that are exposed to the development of infrastructure, including construction, raw materials, product and equipment, and transportation. And these are all US companies doing US infrastructure. And that's, I guess, what makes it nice, because you have the US well brought out blend of stock, and then you have that growth filter or the growth sleeve with PAVE.
Yeah. It's really interesting, the lineup, right? in particular lately with FANG. FANG's been so popular because you said like the Mag 7 isn't included there. But one of the reasons, Billy, that FANG has done well recently, this is not the big part of it, but the currency impact has been very positive for Australian investors. And I just mentioned it off air a moment ago, is there's also a currency hedged version of FANG. How do you think about that? Because, at the time of recording, we happen to be recording this around the time of the RBA rate announcement in February. And so that has implications for currency. How do you think about having exposure to FANG? Let me put this a different way. If you were allocating to FANG or the currency hedged version, let's say you have a 3-year view, would you have a preference? And then over 5 years, would there be a different preference, for example?
Yeah, so it's a tough question, but I think for right now, there's a very, a good conviction or good proposal to be actually positioned in a hedge product, whether it be whatever it is. So in terms of having a hedge fund, what that appeals to investors is because obviously they know the stocks within them very well. The Mag 7, you've got very high innovative names, very successful names in the past 2 years, the key drivers of US market. But also we have investors who are, I wouldn't say tactically, but they're also looking at the Aussie dollar, which has been very, very depressed or suppressed in the past year or so. And they're saying, hey, if there is a potentially stronger Aussie dollar against the US dollar, there must be some hedging that is required, especially if we are dealing with underlying US denominated equities. And I guess this is where the appeal or where the demand for a hedge product or even hedge fund comes from. It's because there is that tactical view of having a Aussie exposure when you're buying overseas or US equities. And this is probably more so to your point that, it's especially for FANG because they're so household names, high growth names, and I guess key drivers of the overall global market as well.
One of the things that, just to go a bit deeper on that, one of the things that our community thinks about a lot is, so not just deciding, because I kind of gave you a false choice. I said you can only choose one of these two things, but in reality, most people would have both, or they'd have a percentage of each, One of the things that our community struggles with, and to be honest, me in a way, is knowing how much to hedge at what time. And a lot of financial advisors that I speak to just basically break it down the middle. They go, well, I'm going to hedge half of my ETFs or half of my shares and have unhedged for the other half for currency reasons. Is there anything that you've come across in terms of how you see people thinking about that?
Yes. So again, this goes to a little bit more technical now, but essentially I would say what you've heard and what you're doing is probably the best way for investors to hedge in any way, taking a 50-50 split or maybe taking a slight tilt whether or not you believe the Australian dollar will appreciate or depreciate against the US dollar. Now, to answer your question more specifically is there is a way, but it's very, very costly. And very, very complicated, and it's called dynamic hedging. Yep. So essentially you hedge whenever something goes up or depreciate or appreciate, and you change that hedging ratio depending on where it's heading. And honestly, it's not cost efficient. So I would definitely agree with you that it's much more easier, and it's just generally simpler to simply have a 50-50 split between a hedge product that you believe in strong structurally.
Interesting. Okay. Yeah, because that's what from a lot of my research, like funds research days, that was a really popular one. And then there was other stuff, which was kind of more like technical analysis over currencies. And if you're a fundamental investor, that kind of doesn't really jive with how you think about like what you should be doing in timing entry and exit points. But then a lot of it's kind of, for me, Billy, has kind of come back to the idea of like long-term averages and just being kind of like really simple with the design of it and trying to remove one of the complexities from an already complex investment world.
Correct.
It's just simple often works.
Yes.
And it's not always precise, but it can get most of the way there to what you want.
Correct. And that goes back to our question or discussion about, how I invest and, just play to your edge. Don't make it don't overcomplicate things. Like you said, if you believe in certain industries, that's the way to go.
Yeah, I like it. So I'll put a link into all of these different ETFs. I know the community is really interested in FANG, but also the hedged version. But also the Russell is a really interesting complement for people, I think, I think it was actually really good timing, particularly with that kind of evolution that I was talking about with like the trickle down of AI impact across the market. Like we even see this in our business, Billy, and we are probably the businesses, like as in the Rask business being very small, are the types of businesses that are least likely to benefit. Like we'll have significant benefit, but not in terms of the overall pie of benefit that comes from using AI and technology more in businesses these days. But I think these are the types of companies that will accelerate faster than before. So I'll put a link into all of that literature as well as other commentary that you've had. But given your kind of experience and your background, one of the things that I thought might be a bit of fun, this is more of a bold call, Billy. So over 10 years, I'm going to get you to zoom out to a decade and say, over a 10-year time horizon, and obviously past performance and investing is risky, and there's a lot of other asterisks that we would insert here, like don't take this as a recommendation to anyone. It's more just to hear how your brain thinks about this, is over the next decade, if I asked you to pick out of the US market, Chinese equities, Indian equities, European or Australian, which of those or which one in particular do you think has the ingredients to perform or outperform the others over time?
Yeah, it's definitely US or China. And the key reason is not because the other countries are not growing or economic or fundamentally not sound. It's simply because I have a strong conviction, and I guess we have a strong conviction that innovation and technology will be driving the future, whether it be 2 decades or 3 decades. There are only 2 countries that you listed there that had strong innovation power or ability or capabilities is definitely China and US. And I'm not saying the other countries don't, but in terms of where the tilt is, I think European is more about energy, geopolitical stability. India is obviously growing from a young population, which is great. Australia, which has their own banking, financial, and a strong energy and mining resources. But I believe in that innovation will be where it's driving. And I think just probably share with you one data is I think what artificial intelligence is doing right now is still its early stages. The data that I want to share was we've looked at artificial intelligence impact on labor productivity globally, and it's only impacted about 3 to 4% or improvement. And that's not saying it's not good, but it's saying that it's in the early stages. But if you look back in the industry, say 18th century or 17th century, when there was steam engines, when there was planes and cloud computing, the productivity increase was actually over 50% or 60%. So what we're seeing right now with artificial intelligence is still just the tip of the iceberg. And going back to that question is I see probably China and US most likely to succeed in terms of innovation, improving AI, and adapting to that to improve the productivity, which is the key to, I guess, growth.
I like that answer, mate. Well, thanks for hosting us in the office, and thank you for taking some time to join me on the show again.
Thanks for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.